Welcome back, everybody. Time for our second video. So this session, we're going to be covering a 100+ unit deal that we co-developed. So, Greg, time for number 2.
Glad to be back for number 2.
I know, yes. So we're going to roll through some questions. And again, this is a real life scenario. So question number 1.
I didn't even change my clothes for the second series.
I know.
Yeah, that's good. Just thought I'd let you know that.
Yeah. Well, clothes look good.
Thanks.
So, okay, question number 1. What's the main differences with syndicating a small deal like we just went over versus a 100+ unit deal?
Yeah, I think the 3 big issues are, number 1, you got to raise more capital, right? And so a smaller deal, sometimes you can do it with friends and family. With a bigger deal, you're going to have to go outside of that group. And so you've got to be able to raise capital from other people maybe that you don't know initially or don't know really well. So that's big, which means you got to raise your game as far as how professional your materials look, things like that. Absolutely. That's a big one.
It's different level.
Different level.
Yeah.
I think the other thing is the construction, or if it's a construction project or a rehab project, it's more complicated, right? There's bigger numbers involved, more opportunities for things to go wrong. You know, if you're digging into the dirt, right, there's more issues there potentially. So there's a lot, you need more contingency, I think, in a bigger project. You need contingency in a small one, but in a bigger one, there's just a lot more opportunities for things to get screwed up, right? Whether it's with the contractor or whatever.
Yeah.
And you need to plan for a fairly lengthy lease-up period, right? So that's important. And then the third thing I think is just financing, because you're going to be borrowing a lot more money. The lenders are going to look to the sponsor for the net worth to support the backstop guarantee, right, on the financing. Even if you are able to get non-recourse debt, they're still going to look at you and want to know you have experience and you've got enough of a balance sheet to provide that. And if you don't have that yourself, then you've got to go find somebody who does and can partner with you, right, to help you co-develop it. So those are the 3 big things on bigger projects.
Yeah, no, exactly. Yeah, right on. Great answers. Question number 2. What's most important in a 100+ unit syndication? What would you say are the biggest benefits? So when we, obviously with this deal, and I'm using a deal that we did in Des Moines as an example, our mindset is always long-term. That's how we see things. That's our company. That's part of our philosophy is planning and preparing for the long term, which a lot of people don't do. So we thought, obviously this deal, we're going to hold on to it for 30, 40 years. So that was our biggest benefit is let's build this, let's put the right team together. But what are your thoughts as far as benefits for syndicating?
I think larger projects, you do have that opportunity. I think one of the tricky parts about doing a long-term deal is a lot of investors, right, if you're raising more capital, they don't want to be in something for 30 years, right? And so you got to find the right partners if you're going to be in it that long. Or you have to structure your deal in a way to allow partners. Like a typical real estate deal would be you'd buy it, rehab it or build it, lease it up, run it for 2 or 3 years, stabilize it, and sell it, right? So you might be a 5 to 7 year deal, right? And
that is typical.
And that's a typical real estate syndication deal. And so most investors are used to that, right? They're not wanting to tie their capital up for 30 years. And so you have to figure out a way either to get their capital back to them and provide a return, or take them out at some point and have a provision in your limited liability company agreement or your partnership agreement that allows you to give them an opportunity to get out, and you got to figure out how to finance it, which typically means you're re-syndicating again, right? You're going in and, there's usually not enough money in the project to just refinance it and take out investors. So you have to go out and do another round, right, of new investors who are coming in and saying, hey, I want to come in now 7 or 8 years later on a stabilized project, which is a different type of investor than the one you did on the development side. So you take out the development guys, they get a nice return based on the value of the project, and then you bring in some new ones to replace them that are going to be in there for the longer term, like what you're looking for. So you got to plan for that ahead of time, because trying to do it later is really hard.
It is. Yeah, it is. No, and that's a great point, and that's true. And it brings up benefits is we really want to syndicate and do deals with like-minded individuals who we're on the same page with. This is where we're going, this is what we're doing, and that makes it a heck of a lot easier.
'em. Yeah. Yeah, it's really hard. I've noticed that. I think one of the trickiest parts about doing a long-term deal is a lot of investors, right, if you're raising more capital, they don't want to be in something for 30 years, right? And so you have to figure out a way either to take their capital up for 30 years, or to get their capital back to them and have a provision in your limited liability company agreement that allows you to get out of something. And so you know, at my law firm, we have about 26 lawyers, right? And one of the lawyers in there does family law, and she's been really, really busy right now with COVID because there's a lot of divorces going on, right?
Yeah.
Because of the stress that's been put on families and things like that. And it's become more of a thing, which is sad, but it's a reality.
Yeah.
And the same thing has been true, I've been noticing with business partnerships, that, you know, what's gone on in the economy has put stress on some partnerships, and that's caused partners to go different ways and kind of accentuate maybe a disagreement they had over either they were long-term or short-term or whatever.
Yeah. What was communicated?
And so it was forced out some partnerships to kind of break up or sell or whatever.
Yeah.
And so having that alignment in the beginning, you know, hopefully can avoid some of that if you can do it that way when you get into a stressful period.
Yeah, no, it's exactly right. Yeah. It's important to be like-minded and communicate, to be on the same page.
Yep.
Yeah. No, that's good. Really good.
Yep.
Great. Real life examples, which obviously aren't fun, but it is what it is. It's what we're dealing with in this COVID environment. So, question number 3. What are the main issues that typically come up? So our biggest problem, we'll share on one of our problems that we had when we were doing this deal is we're going to sign on our loan, we're going to fund our project, and we had an issue with a contractor, and I can't go into too much detail actually on it, but just wanted to share a real life example where it was completely out of our control, and someone was actually fired and let go based on the situation that transpired. So our project was delayed. We couldn't fund the deal. We actually were pushed back. Which happened. But what have you seen as far as typical issues that have come up?
Yeah, that's pretty typical. Like we mentioned in the first series, right? One of the key things is to have a good team, right? We have a good contractor, good lender. If you're going to have a separate property manager, you have a good property manager. All those kinds of things are important, and especially in a ground-up construction project like you're talking about.
Yeah.
And your lender makes the loan based on your team, right? And so if one of your team members fails, right, like in your case with the contractor, and you have to replace that contractor, that screws everything up because the lender also is like, hey, look, we're not, you don't have we've got to revet whoever your new contractor is. On a smaller deal, it's not so hard, right? If you have somebody who's going to come in and replace all the windows, or you're going to do some rehab, and the lender loans you the money, and that contractor screws up and doesn't get stuff done, you fire and bring in another one. Smaller deals, it's not that big of an issue. But for a bigger deal, the lender is completely relying on the team. And if your property manager fails, or your contractor fails, or another key team member is not following through and not meeting deadlines and all that kind of stuff, and you have to replace them, that's going to delay your project, no question, every single time, and it costs you more financing costs. There's transition costs, there's all sorts of things. So a lot of budget impacts, right? Cost overruns, all that kind of stuff can be not fun. And I know that's one of the things you go through, right? Yeah. And that's the challenges of developing a project.
Yeah, it wasn't fun. We had delays, we had costly delays, and we had to find a new contractor, and our team was phenomenal. We got the deal done. We got it leased up very quickly because we built a great product that was in high demand. But that was a problem that we had to solve. So.
And that's an example of like having a good partnership, right? Whoever you're aligned, because it's going to that example is going to put a ton of stress on the partnership.
Yeah, it did.
So you got to be able to have partners that are aligned that can work together to hunker down and pull through something like that.
Yeah, and that's exactly what we did. Is we communicated, talked about, okay, this is our problem, and how do we solve it? So, and really in our situation, I'm good at some things, and some of our partners are actually better at others. So I think part of a good partnership is understanding your strengths and where your partners are better. So I think that was huge for us, because that was obviously on this deal, one of the issues we faced, but there are other ones as well. But we're good. We're a good team, So I mean, just like any good team, you know, like the NBA, you have good shooters, you have folks who can pass.
You have the postman, right? You're the post guy, right?
Yeah, exactly. So moving along, question 4: what advice would you give for syndicating a larger project similar to this? Any advice?
I think, as I mentioned a little bit earlier, you got your documents need to be a little more professional. So I think you need to have really solid, like our typical document package is going to be a term sheet, right, which is several pages that lays out the details of what the investor is going to be getting. You want to have a really good LLC agreement that looks well done.
Yeah.
It deals with the potential issues that might come up, like you're just describing, and what happens when those kinds of things happen, how is it resolved. So all that's figured out ahead of time, so you don't get stuck and go, oh, now what do we do? And then we have a subscription agreement that the investor signs off on that has all the risk factors and the disclosures. And then you have some kind of a pro forma, right, package that shows returns, talks about the project, does all that kind of stuff. And I think having a really nice, clean, solid, professional-looking package going out to a group of investors on a larger project, that's super important. Yeah.
No, I agree. I realize, the way a lot of people do one thing is the way they do all things. So, and typically, I've realized, being doing this now for a long time myself, is whether meeting a contractor or meeting a lender or meeting whoever, typically the beginning ends up being how it is. So if you have a clean, really dialed in package, I think it just shows really well with how you do business.
Right.
So you're organized, you're put together, and as much as some folks might think, it's just a package, it's an introduction into how you do business.
Right. So, you only have one chance to make a first impression, so make a good one.
Yeah,
right?
Exactly. Yeah, exactly.
The other thing I think, Andy, sometimes that comes up in that is you're needing to raise more capital, so you're having to go outside your normal group. And I've seen people make foot faults on what the rules are around syndications. So like the typical, deal that you do for like the Adriana or whatever, you're going to go to accredited investors, right? So that's the typical exemption that people get, right, when offering investments in real estate deals, is we sell to our investments to an accredited investor. So that's somebody who has a certain level of net worth and a certain income level that the SEC and the state regulators say they're big boys, they can figure it out. Big girls, they know what they're doing. But under the traditional rules, you can't publicly solicit those people. You have to know them. You have to have a relationship with them in some fashion, right? You have to have had conversations with them. There's a new rule, right, that allows for more public solicitations called 506C, right? The old rule was 506B, this is 506C. In 506C, you can advertise your offering, right, to the public. There's different rules around how you vet people and are they accredited and so on. You have to follow those rules. And the mistake I see investors or syndicators make, or sponsors, is they will see other people advertising their deals on LinkedIn or through other public forums, websites, and so on. And those guys may have registered under 506C. They haven't. And if they do that kind of advertising, it disqualifies the whole offering and creates a bunch of big problems. So with larger deals, I see people are starting to push the envelope a little bit because they can't get all their investors lined up and they're starting to advertise things. And if they haven't set up the offering correctly at the beginning, then they're going to have problems.
Those are problems. I can't go over that line. I know, because it's
and
too
some people
dangerous.
just don't even know it, right? I mean, they're well-intentioned, right? I can name a couple of fairly large syndicators I know in the area who tripped that line the last year or two and did it inadvertently, right? They didn't realize they were doing it incorrectly, and it wasn't being malicious, right? They were just ignorant about the rules and made some mistakes. And they were sophisticated, large syndicators, so you would think that they would know, and they just didn't.
They just don't.
Yeah.
Got to know the rules, and that's part of why I wanted to have Greg on, because Greg and actually Greg has a great team as well. I mean, a fantastic team. But having the right team, having the right people, is huge. So that if you're going to make a mistake, I know you would say, don't do that, right?
Well, I would hope so.
Yeah, exactly. So it's like those things are huge. So yeah, we're really good. And by the way, I like the foot faults comment. I'm a tennis player.
Right. That's I played a little tennis in my day too.
Nice.
So.
Okay. Question number 5. What effect has COVID, obviously the environment that we're in, had on some of these larger projects? And what are you seeing out there?
Yeah, I think there's some differences, smaller projects and larger ones. But again, if it's in construction, there's been delays, right? COVID has caused construction delays. The larger projects, like we talked about, have had challenges with tenants, right, and the eviction moratoriums that are in place. So it's hard to get a tenant out and replace them with a rent-paying tenant. And so those created some challenges for some of the larger projects. Not as much in the Seattle area, I think, but it's still been a challenge. And then I think the bigger issue has been the financing.
Yeah.
Finding the right financing, underwriting standards are tighter again. And so that applies both to small and large, but particularly to the larger projects because there's more debt involved there. And the lenders that you're talking to are usually the larger lenders. Mm-hmm. They are definitely a little more conservative right now on what they're doing. So that's caused some projects to either have to raise more equity or put on the shelf because they can't finance it the way they want. Yeah, like they could have a year ago.
Yeah, no, it's huge. The financing is tighter. We're actually going to be having Michael Gaberman from Washington Trust Bank on, which just going over some of the lending standards currently. But yeah, it's tighter. Funds needed at closing, as well as reserves have gone up. Debt cover is tighter as well. So we'll be covering a lot more of that, but that's a good point for sure. So, well, that's it, Greg. Thanks for joining us again for video number 2.
Yeah.
So we'll continue, everybody. So hopefully you can join us for the rest of our videos. Otherwise, thanks again for joining us.